Good morning, everybody. It's fantastic to see this amazing crowd here. We are back to pre-pandemic numbers. Over 500 people registered today, so that's terrific. Whether it says something about the markets or not, we'll see, but I think it's a good sign. On behalf of my co-chair and friend and partner, Adam Emmerich, we really want to welcome everyone. We're thrilled to see all of you here. Before we get started, a few thank yous to the NYU team that put this together, starting with our fantastic partners in crime, Dean Norman and Scott Robinson, who runs the REIT Center at NYU. Amazing amount of effort that went into this, and we really couldn't have better partners to do this with, so thank you. And the incredible team led by Jessica Watson and Karen Gabbard, who is somewhere here. She doesn't usually come, but she made it today, so thank you for all of the efforts. For those of you who've been here before, Adam and I often start the conference with a few predictions about where we think the world is going. These are made in the spirit of getting the discussion going and following JP Morgan's advice that if you're going to make predictions, make them often and make a lot of them. So take them for what they're worth. But three predictions today, which I think we're going to talk a lot about during the conference. One is going on offense. We are calling the bottom at this point. Our sense at Wachtell Lipton is that this is the moment where many REITs are going to start taking advantage of the opportunities that have been created by the uncertainties out there, by the post-COVID situation, by the interest rates and debt maturities coming due. Huge amount of opportunity out there. REIT balance sheets are strong, management teams are strong, and we think this is the time where REITs are going to get going. They have the advantage of stock currency to make acquisitions, and we see a lot of that coming. So that's one. Two, digitalization. Elon Musk predicted that AI will outsmart humans in a year to 18 months. We're upping the ante. Maybe we're not so smart, but our sense is AI has already outsmarted all of us. And the opportunities that that's going to create for nimble REITs as they adjust to the new realities, we think are tremendous. Sure, there are lots of scary things about this, but the opportunities are also massive. So that's two. And the third prediction is growth. We looked at some of the data out there, and the REIT market cap for the entire industry, the equity market cap, is now double where it was 10 years ago. 1.3 trillion today, half of that 10 years ago. We knew it was growing, but that is an interesting number. There are 17 REITs now with a market cap over 20 billion, and those REITs represent a growing 60% of the entire market cap. So tremendous growth and tremendous consolidation coming. Our sense is the next 10 years should be roughly similar. So a doubling of the market and more consolidation into the larger players. So lots to do. With that, let me introduce our dean, Mark Norman, who has been leading the Schack Institute for a year and a half now, and has been doing tremendous things to reshape and reposition and move it in some very exciting directions, including, and you'll hear about it from the dean, a new REIT stock investment fund that has been created. So with that, Dean, let me welcome you up.
Welcome. Good morning. On behalf of the Schack Institute of Real Estate, I just want to welcome you to the 28th REIT Symposium. I can't believe it's been 28 years, and Robin and Adam have been at the helm of that. And it really furthers our mission by really creating the future leaders of real estate development and construction management. And there's no better way to marry what we teach in the classroom to events like this. And so one of the things we like to do is also create ample time for mingling and also receptions afterwards. So very happy about that. This definitely has a special place in my heart. I can't believe it's only been a year and a half. But Robin and Adam invited me to the first REIT Symposium, my first REIT Symposium, to do a one-on-one with Stephen Ross, which obviously was a test. And last year, the one-on-one with Sam Zell, which we were so sorry to hear about his passing. But all of that to me is really a testament to Adam, Robin, Mary Hogan Press, and the other people on our REIT board's presence in the industry and just the caliber of speakers they can bring to us. So today I want to thank our sponsors, American Tower, JP Morgan, UMH Properties, Kilroy Realty Corporation, and also our media partners, Real Deal, Commercial Observer, and Green Street. This also wouldn't be possible without our amazing faculty. So Scott Robinson, first and foremost, has really created a differentiator for us at Schack, running the REIT Center, doing the REIT series, and now leading our new student-run REIT Securities Fund, which you'll hear from actually as the last panel of this conference. And then over the last 2 years of this conference, we've had topics that have included return to work, inflation, interest rate rises, hope for interest rate cuts, and then we also can't ignore all the consequences of everything else going around us in terms of war, frankly, the supply chain crisis. And Sam Zell said, actually famously, all the opportunity in the world means nothing if you don't actually pull the trigger. And some of the firms you will see today are starting to pull the trigger. To Robin's thoughts, maybe we're at the bottom. So today we'll also get into the specifics, whether it be the one-on-one with John Gray from Blackstone or the one-on-one with Sharon Wilson-Janot at National Multifamily Council, or our investor roundtable or our Actionable Trends panel. We also have instituted the networking afterwards, so please do join us afterwards. And there's really no substitute for hands-on knowledge. So listen today. These are the leaders in the industry, and they're prepared to talk about pretty much every sector, and that's what makes me very excited about this conference. So without further ado, I'll bring up our first panel. Jeffrey Horowitz, Global Head of Real Estate, Gaming and Lodging at BofA Securities, will moderate. And welcome, Jeffrey.
Good morning, everybody. Nice to see so many people here early in the morning and some real familiar faces and some new ones. Our panelists, as they gather here, I want to first thank Robin and Adam. I got the AllStar Panel today. I've got just a terrific group of people who've got all different types of sector history and experience, and we're going to have a good time today. We're not going to start with predictions like Robin did. We're going to wind up asking some people some questions as we get started too. So why doesn't everybody have a seat? Okay. And what I'm going to do is I'm going to introduce our panelists. I am going to ask you some questions, make sure everybody's kind of alert, and then I'm going to kick this off and see where this goes, and we'll leave 5 or so minutes for a Q&A. So to my left, we have Angela Aman. Angela is a new CEO. Congratulations. She runs Kilroy Realty, and Angela and I have been friends for a long time. Before that, she was at Brixmor, where she was president, CFO, and treasurer, who is also at Starwood and is on the board of Equity Residential. Tom Bartlett, who is the advisor to the CEO of American Tower and was a CEO before that and has a very illustrious career. We can get into all kinds of conversations with a true global leader, Debra Cafaro, next to him. I don't think Debra needs a lot of introduction, but Debra is the head of Ventas, and I didn't know this till I saw your bio, You started when the company was $200 million in size, which
Yes.
Pretty amazing in the context of where we are today. But Debra has been named, one of the world's most powerful women and many, many things. And for some side note things, Pittsburgh Penguin owner as well. Next to her is Ron Havner. Ron is the non-executive chair of Public Storage and was the CEO for many, many years. Ron was also the head of PS Business Works before that. And Owen Thomas, the chairman and CEO of Boston Properties. He also was the first chairman of Lehman Brothers in 2012 after it kind of emerged, and had many roles at Morgan Stanley for a long time before that. So I want to make sure our panelists have a good sense of what our audience is thinking. So I want to ask you all a few questions just to start. So the S&P 500, been near a top. Will it end the year higher or lower? Who thinks it's going to be higher? Okay, I got some optimistic people here. We had growth person visualization before. Good. Who thinks it's going to be lower? Okay, so a little more pessimistic side. Fine. Will the REIT industry or REIT sector be higher or lower at the end of the year? Higher? Good. This is a REIT conference, so a little optimism would be great. Okay. Interest rates. Will the 10-year hit 5 or will it hit 4 first? Which one? 5? Okay. 4? Okay, so you can start to see how the world is playing out. Is the biggest issue outstanding today inflation? Is it about debt maturities, geopolitical? Who says inflation? Pretty much nobody, okay? Inflation is supposed to be good for real estate. Interest rates, biggest issue. Geopolitical. Wow, interesting. Okay, good. So I think our panelists have a little sense of who they're talking to today. And we're going to start it out with Owen. And Owen, you and I talked a little bit yesterday, and I'd say, this is really just an interesting world we're living in right now. It feels like every presentation that we put together is stale by the time we present it. And, if we were here 6 months ago, we would have been talking about 6 or 7 rate cuts. Then it was 3, then it was 2. Our economists came out 1. Some people say it'll go up. So this is really a tricky time. And I think one of the hardest issues that I talk to about with CEOs and boards is how do you take businesses that have long-term assets and really a long-term plan and deal with all the idiosyncrasies of what's happening each day? I mean, most people didn't know about, Israel and Iran until, a few weeks ago, or Hamas, or Ukraine, Russia. All these different things are going on. And so in many ways, we've taken this very global world and we're deglobalizing it too and made it really unsafe. So I think the first thing I want to ask, Owen, is when you sit in the Boston Properties boardroom, what are some of the key things that you're talking about? Putting aside, will there be more office leasing and those kinds of things, just macro issues that you think about today.
Yeah. Well, good to be here. Thank you, Jeff. A lot of hedging going on in this audience. When you were asking all these questions, half the people didn't vote. So, it was kind of hard to get a feel for what was going on. For what we do, and I think this is true of a lot of REITs, there are 2 primary drivers in the market that we think about. One is pretty obvious, which is interest rates. Look, we could talk about it all day. It's kind of a fool's errand to try to figure out how to predict that, but there's absolutely no question that it's critically important to the real estate industry and particularly office, period, full stop. So, and by the way, as a leader of a company with investors and people and so forth, my job isn't to predict. My job is to be prepared for every outcome and make sure that our ship sails successfully through those different environments. So that's one, that's interest rates. The second thing, which may be a little less clear and certainly is true in the office sector, is corporate earnings. So, we operate in a capital market and we operate in a property market. Capital markets are driven by interest rates. Property markets for us are driven by corporate earnings. Our clients are not individuals, they're companies. We're a B2B business. If earnings are not growing, CEOs are not hiring people, they might be letting go people, and they sure as heck aren't taking more space. So if you look at certainly BXP's leasing activity, it's all correlated to S&P 500 earnings growth. And by the way, that was 0% in 2023 and it was 5% in 2022. So we talk a lot about that, what's going on in the corporate world, which sectors are going to be doing well, where are they located, and where therefore should our business be located. So those are the two key drivers. I'm not sure there's a whole lot we can do about them, but understanding them and what those outcomes might lead to in terms of investment opportunities. And then those two lead into, I think, the four drivers of the business, which is the FFO per share or the earnings per share. So we have interest cost. So again, I talked about rates, that's really important.
Sure.
So for all REITs that funded their balance sheets properly, meaning they did a lot of bond deals over the last 10 years, they're facing higher interest rate costs. So to grow your FFO today, you don't have a tailwind anymore, you've got a headwind. So that's number one. Number two is the same store. So the properties that you have, how do you make them grow? And that's really important. And if you've got the right properties in the right markets, those should be growing. And again, for us, that's related to this S&P 500 or earnings corporate growth. And then the third are external. And for us, that is development. You know, we are a REIT and we're an owner, but we're also a developer. So do we have the right sites? What's the cost situation? What clients might be interested? Today, that's difficult because costs have gone up so much and they've gone way ahead of rents. And so to build a new building, a client usually gets a discount for going into a new development. Today, they have to pay a premium for us to build a new building. And then last, which potentially I think is the most interesting right now, are acquisitions. Because at least in our space, there's a lot of challenges. You know, we're fortunate that we're a public company because we can actually access capital. We can issue bonds. We're an investment grade rated firm. We don't, you know, no CEOs really like their share price. We don't want to use it, but it is a currency that potentially you could use to do something if you wanted to. So we have access to capital. And there's a lot of dislocation going on in the office world. There's tremendous illiquidity on the private side, and I think that will ultimately lead to acquisition opportunities for our company. So those are the cocktail of things we think about.
That's great. You've unpacked a lot, and I'm going to start to dig into some of those. I'm going to stay a little bit top of the waves first because I'm going to ask Tom, you know, you're probably the most global REIT or one of the couple most global REITs that's out there. And, you know, when I look at where your assets are, they're not in harm's way, fortunately. But so how do you start to think about, you know, growth from a global perspective given what's happening today? You know, do you start to say, I'm going to start to concentrate more in certain places and really stay away from others? How do you think about that?
Well, I mean, to follow on to kind of what Owen was saying, I mean, for us, it's all about capital allocation. Whether you can be buying back a share of stock, whether you're going to be buying a company, or whether you're going to be, you know, building data centers or cell phone towers in markets around the world. And so it's all about risk-adjusted rates of return. And so it gets down to a very, you know, local country level. One of the interesting things about digital infrastructure is that it's the same globally. So a cell phone tower looks the same in New York as it does in São Paulo or it does in Joburg, and it similarly is a data center. So you have very similar technology, very similar footprints that you're looking at in a global basis. And you know, roughly half of our business is outside of the United States. And we do have a fair amount of business in emerging markets. And so a lot of the things you're talking about, whether interest rates, inflation, a lot of the geopolitical issues are very relevant in our boardroom when you start to think about the markets that we're in. Over the last few years, we've really doubled down on developed markets. And so, you know, we bought a sizable data center business here in the United States for about $10 billion. And similarly, we bought a large portfolio of cell phone towers from Telefonica in Western Europe. And, you know, we look where we can actually generate the highest rates of returns. When I originally started as the CFO, you know, people ask, well, how much business are you going to do internationally versus domestically? I said, I don't know. You know, we're just going to take a look at where we can generate the best rates of return on a risk-adjusted basis, and make our investments that way. And that's how we landed in Africa. That's how we landed largely in South America. That's how we landed largely in India. But we also then, you know, we're managers of capital, and we've made the determination over the last 2 years that that's not a market in India where we think we can really be competitive. Yeah. And so we're pulling up roots in India, and we're going to allocate that capital in other parts of the world, or buy back shares or do those other types of things.
Yeah, it's interesting. So when you brought up this notion, and I guess Robin did too, of access to capital, and each of you work with investment grade companies, right? So as we think forward, and Ron, I'm going to throw it to you because you've always had a philosophy of a very, very strong balance sheet, and the naysayers who talked about preferreds probably wish they had some 5% preferreds right now. But when you think about that versus the private players, right now there's some that view that assets are priced better in the private markets than the public, which seems a little funny given the lack of liquidity some of those folks have and given maturities that are coming up. And some of it may just be fake valuations because not much is traded. But how do you start to think then about this access to capital, the importance of it as we fast forward over the next, really handful of years? Because if you think about debt maturities are, call it $500 billion a year for the next 5 years. And for most folks, if you're a bank, maturities are 3-4 years. So all of this stuff that was purchased in 2021, et cetera, is coming due. So how do you start to think about offense? How do you think about using that balance sheet? Do you see stress in the private system yet, or is it still too early?
That's a lot of questions.
I know who I'm talking to.
Our business, so we have 3,000 properties, 38 states, 2 million customers, 6,000 employees. So we spend a lot less time than Owen does thinking about corporate America, and we weren't in garage space, so it's pretty simple. In terms of access to capital, I commented at dinner last night. There's 35% of the debt in the REIT industry is coming due in the next 5 years, and it's priced at an average of 4%, and it's going to 6%. Okay, yep. That's a 25% headwind to earnings over the next 5 years. Okay, and I think all of us have that headwind to some degree or another. Does it work its way into? Can we raise our rents that much? I doubt it. How are we going to overcome that earnings headwind? And it's a challenge, and I think we've had a great tailwind for the last 20, 30 years with declining interest rates, and I think we've got a big headwind for the next 20 or 30 years with rising interest rates. In terms of our access to capital, and I see everyone here because all the companies are investment grade, I think we're in a very competitive position with private equity. We have the common stock, which hasn't done great lately. Our stock's off 30 points in the last 10 days. So it's a headwind, but we have that, and we have access to the debt markets. And so I think the REIT industry as a whole is very well positioned to access capital and take advantage of opportunities. We see guys, because we're kind of a mom and pop business, most of the operators are. I mean, they've built properties, they can't fill them up, they can't get financing, and so that's returns on invested capital are marching up quarter after quarter.
So you start to see the pipeline start to build for one-off assets, or not yet?
Yeah, I mean, it's building, but it's ones and twos. There's not right. Big portfolios that are under stress at the moment. Yeah. But I see it continues to build, and because access to capital, especially for smaller operators, is very challenging.
Yeah, I think.
And
that,
I think all of us have a real competitive advantage in that arena.
One of the frustrations I've experienced with a lot of companies this past year is there hasn't been much for sale, right? And why would there be? If you thought rates were going down a bunch, why would you sell, right? Why would a bank push someone to sell? So this last week or two, I think, is a very important one. I think it's a little early to tell, to see what happens next. Mm-hmm. Because at some point, the maturities are maturities, and they're coming. And a lot of people bought assets over the last few years with the notion of negative ARB, hoping that growth would come. And now we're starting to see this margin squeeze, as you kind of talked about too. So Debbie, how do you think about this as well? I mean, you also have some tailwinds from a demographic perspective, which are a little different than some others, but just broadly speaking.
Yes. So as you know, Ventas owns $35 billion of assets that are aligned around an aging demographic.
Right.
And half of that senior housing.
Right.
And we've certainly gone through the ringer over the past couple of years with COVID, but the environment now is as good as I've seen it really in my tenure. And that's because we have these strong demographic tailwinds with the over 80 and the demand that comes with that, the pricing power that comes with that. And then we've got very low supply in senior housing. So it's reminiscent of right during the financial crisis when starts were 1 to 2%, and yet the demand now is much bigger than it was then, a 24% 5-year projected growth rate for the over 80 population. And so that gives us, I hope and believe, the ability for property growth to outpace, hopefully, the interest rate increases. And that's a very advantaged position within the broader commercial real estate market. We also are seeing external growth opportunities. I've never seen this quite fact pattern where there's a ton of embedded growth and relatively high going in yields on asset investments because of there's $19 billion of senior housing maturities in the next couple of years, and NOIs aren't back to pre-COVID levels. But I agree with you, the last couple weeks, I think people who've been holding on in banks and borrowers about, well, rates are gonna come down shortly, let's just kick the can. I think that psychology is going to change, particularly at the lenders. And owners who have a business, a platform that can be bolted on, that are good owners, that have financial strength and flexibility and liquidity, REITs, access to capital, I think we'll be in a unique position.
Yeah, I mean, I've been a fan for a while that this is the public market today, right? When rates went down, those who use more leverage did better, right? That's all gonna unwind, and there's not many buyers of things that are of scale because cost of debt, et cetera. So it's a very interesting moment. So the question is, when, to use Robin's term, when do you go on offense? When do you start to take that capital that you have and say, you know what, I'm never sure when the bottom is going to be called, although I think you called the bottom, but Robin called the bottom. But when do you think about offense? And Angela, so you're in a new spot, right? You've suddenly gone from East Coast to West Coast, right? Retail to office. First retail was a little rough and came out pretty strong, and hopefully office will do the same. How do you start to think about that in a new position, offense, and how to do new deals? Because there's going to clearly be distress in all of our marketplaces, right? And I think that this is the moments where REITs should shine. Hopefully there'll be the capital and support from the investor community too, but we'll see. What's just your general thoughts on it?
I make a few comments on that. I think, to start with, Kilroy's strategic pillars have been probably pillars that every company on the stage has had historically, which are a premium portfolio, premium quality assets, strategic capital allocation, fortress balance sheet, which to your point, I think plays really well in the current environment. I think the challenge in our sector, and Owen did a good job of highlighting some of the challenges office has today, is really defining what is premium quality assets in the current environment, both right now, given all of the disruption we're seeing today, but as we look out, there was a speaker earlier that mentioned sort of what's happening in terms of digitalization and AI. What do premium properties in this asset class look like, not just over the next 3 to 5 years, but over the next 10 to 15 years? And as a result, what does capital allocation in what is potentially a pretty opportunistic environment look like against that backdrop? So that's the first piece I think we're all trying to sort through and really understand. From just a strategic capital allocation perspective, we're all facing the same challenges, which I think your question earlier, who expects rates to be higher or lower at the end of the year is the right one. I think the reason we just haven't seen nearly as much transaction volume as any of us would have expected is that buyers expect rates are going to be materially lower, and we've got sellers that have to plan. The point earlier about not just not predicting, but preparing. Anybody who's stepping in and ready to be offensive has to be prepared for the possibility or the probability that rates are actually going to be higher before they're lower, and that fundamentally we're operating in just a different interest environment regime, right? I think the market over the last 18 months has believed we're getting back to the interest rate regime we've had, over the last now 10 to 15 years. It's just very possible, and I think we're all coming to terms with the fact that it's not just higher for longer, but it might be higher somewhat indefinitely, right? And so I think all of those questions, come into play as you think about how do we really allocate capital in this environment? How, not just when do we go on the offensive, but to what degree, and how do we sort of navigate all those different cross currents at the same time? To your point, again, there's just been so little activity in the transaction market. We've had time to sort of be thoughtful, and I think prudent in the approach and thinking through all of those pieces in terms of what types of assets we'd want to buy, what comes across in any of our asset classes that looks like distress, and it will be distressed, but it's not going to be opportunistic. It's not going to have the ability to actually sort of recover or hit projections that people marketing some of these distressed assets as opportunistic are likely trying to communicate to the market. So all of that comes into play. There are no clear answers here, I think, as we navigate it. But I agree, and I'm hopeful that, as other speakers said, some of the coming to terms with where we are from an interest rate perspective does sort of lead to more assets coming to market. Maybe not in the very short term, but over the next 12 to 18 months.
Yeah. One of the things I've struggled to think through is when you think about whether it's increased interest costs as everyone's debts roll, generally speaking, higher insurance costs, higher property taxes, higher labor costs. These are huge headwinds. So can you outgrow that? And some sectors can. You might be able to just because senior housing has a certain tailwind. On the flip side, when I look at the potential opportunities that should exist because of lack of access to capital and real destruction potentially in valuation for so many private players or levered players, there should be this enormous kickstart that should really get our stocks going. And so I guess my question, Owen, I'll ask it to you. When you speak to investors, they've kind of been shellacked in our sector, right? I mean, the REIT market's down, 8 or 10% this year. S&P's up 6%. We've been down, 6-7 years versus the S&P 500. So a lot of those folks have lost their money. And so how do you think, what do they say to you when they see this very obvious opportunity that should be in front of us right now?
Yeah. Well, I think the focus that investors have always had, but I think increasingly have in the REIT space is not the whole, what is your cap rate versus the private market, is how do you grow? What's your FFO growth? What's the profile? How are you going to do that? And, in office today, what that means is, okay, when are those corporate earnings coming back, and when are you going to get that same store going? And then what can you do in the acquisition market or in the development market to create external growth? What are those opportunities? And I think investors see that for a well-capitalized and well-managed player in the office space that will generate opportunities. And I think shareholders are going to be supportive of ideas that, one, don't dilute the quality of your portfolio and grow your FFO per share. I think that would be that would be a supported strategy. But I agree with what Angela was saying earlier in our space. You asked the question, when's the right time to go on offense? I mean, for us, it's now. And we're on offense. We bought in JV interests from 2 different institutional partners on 3 assets in the fourth quarter of last year. So that was, in my opinion, kind of the kickstart. But there's this bid-ask spread that's out there. So what you have to do is you have to find opportunities where there's a spark. And in the deals that we already did, the spark was capital. We renewed anchor clients in those buildings, and that required a funding of tenant work and leasing commission capital that the partners didn't want to do. And that led to the transaction. So, the other thing I would say, too, that came up on this acquisition idea, the notion of distress. I think in office in particular, quality is absolutely critical. So I actually wouldn't describe the opportunity as distress. I would describe it as being able to acquire high quality assets at reset prices. And that's what we're looking at. And I think that's a little bit harder to find.
Yeah.
Jeff, and when you're looking at the generalist investors, I would say not the REIT dedicateds, I think they're looking at the banks. And they're saying, okay, the banks are still taking provisions. The banks are just starting to take write-offs. And as we know, the financial institutions can be lagging indicators, right? And I think a catalyst really could be, not for going on offense, because I agree with Owen, we're starting to move our feet already. But for the generalist investor being interested in any facet of commercial real estate, I do think it has to do with either a unique story, that with growth, whether it's towers or demographics, longevity thesis. But really, I think once they see the banks starting to bottom on provisioning and write-offs, that'll be kind of a bit of an all-clear sign that maybe the worst is over and they can get back into commercial real estate, because it has been a laggard within the GICs, over the last 6 years in performance.
It's interesting. So, a question I often ask people is real estate too linked with the banks, right? And I would say last October, November, when rate cuts, really came into the forefront, all of a sudden, my sense was we did a bunch of equity deals, and they went great. Frankly, every equity deal we've done is great. And I presumed...
You said no commercial.
There's no commercial. I didn't say that. Sorry. But what my presumption was, and I don't know if it's true, my presumption was this was a moment when the generalist said, wait a second, I'm underallocated here, let me in. And that's when spreads tighten in bonds as well. And so we've seen really good follow-through on that, despite what's happened. I think partially because the companies that have accessed capital have been growing, right? So they've had a story around it. And Tom, I was going to ask you, you are in the data center business, which is a smaller part of your business, but there's almost not a day that goes by where we don't get a request from somebody who's got either a pretty large private platform or a growing platform. Talk about the growth in that space just for a little bit, because I think it's so topical, and everyone seems to want to get in. Can they get in? Is there enough power in the world? What actually happens?
Well, that's the real limiter, right?
Yeah.
Both on the cell phone towers, we're limited by spectrum.
Yeah.
And on the data center side, we're limited by power. And so the drivers of our business are much different than kind of a typical real estate company, as you well said. And, again, the delta between the bid and the ask is still pretty significant. A lot of private equity going into the data center business, but that's not for the faint of heart either. It's a significant capital that goes into the data center business. It takes a while for you to be able to get to the kinds of yields that you would expect to get to. And now with power, I think really the larger data center companies, particularly in the United States, are the ones that are building out the campuses like we're doing. We'll probably spend $400 or $500 million on CapEx this year on build. But it's interesting, if you think about the U.S. and the power that's created within the U.S., it's roughly 2% that's supporting data centers today. In 8 to 9 years, that's going to be over 10%. So there's a significant amount of power. And you go to markets like Northern Virginia, you go to Silicon Valley, the utility companies there are saying, no more. You've got to generate the power yourself to be able to support your customers. And so, you asked the question about the boardroom, what do we spend time on? It's capital allocation, and it's also technology.
Right.
Where can we and how can we? And I think that's what's really going to create some differences among the data center portfolios, particularly in the United States.
Yeah. And Ron, when you think about, Tom just mentioned the word technology, talk about, the advantage of scale and how you use technology today and how maybe it's used in the future.
Well, we'd been working on some stuff pre-COVID, but with COVID, we went to what we call e-rental, which is basically, do a lease on your cell phone or your computer, and that's 65-70% of our rentals today. We've got gate systems that you put your iPhone up to it and you get into the property, which we didn't have 3 or 4 years ago. So the digitalization just continues to escalate. And I think we've dropped, 20-25% of our workforce because it's automated. And
what are people keeping in those things?
Stuff.
I always wonder about that.
You think you're going to stay 3 months? You stay 3 years.
I don't. I get rid of it. Yes.
So that's a whole different topic. What do they keep in their space? Stuff.
Someday you can give me a tour and I can see what's in there.
It's unbelievable what people keep in there. It's a great business, though.
As long as they pay the rent.
No $500 million of CapEx.
No, exactly.
Just cash flow, no leasing. So anyway, we continue to digitalize our business, starting to do the call center, more digitalization. It just kind of permeates throughout the organization because, look, we're all trained to use this thing, right? We all want to use, everything's done on this, right? No one wants to, I don't want to talk to someone in the store. I want to just do it on this and take care of it. And so that because we're a B2C business, more and more people want to just do everything on the phone, and it simplifies our business model, automates it.
Yeah.
It's going to continue to do that. You're always going to need some people there, right? Because people leave their trash, they leave their junk that they don't want. Property has to be cleaned out, so that you're always going to need some people at the property, but not for all the front end stuff that we used to do. It used to take 30 minutes to sit at the counter to do a lease. Now you do it before you even show up.
Yeah, yeah. And Angela, talk about some of the differences, as you transition property types. And Kilroy was always on the innovative, edge of office space. What do people want, need? How do you see that changing in the future? I'm not talking about amount of space, but just in their space, in their physical space right now versus before. We use this term premium workspace. I know every office company likes to use right now.
Mm-hmm. Yeah, I think it's still evolving, and I think evolving pretty significantly and pretty quickly. I think this push to get people, and I think surprise on behalf of much of corporate America about how hard it's been to get employees to come back to the office, has a lot to do with how the workspaces have evolved over time, and how the way that many companies feel like their workspaces were conducive to collaboration and efficiency and effectiveness just weren't, right? Over time, if you look at the trends, we've continued to compress the amount of square footage per employee. We put people in, at best cube farms, but workstations where people are clustered very close together. And as digitalization has continued to change the way all of us work, working and taking Zoom calls or Teams calls or whatever it is with people externally or people in other offices has gotten more and more difficult to do in that kind of environment, right? And that really kind of came to a head as people were trying to come back, kind of following the pandemic, and just really were sort of, I think, struck very significantly by how much easier it was to do that kind of work at home than it was in these, farms of workstations in offices. So, the response has been, and I think the preliminary response was we need, the offices need to be engaging, they need to be inviting, there need to be a lot more collaboration spaces, clearly a lot more meeting spaces. I think all of that's a good start, but I think the most depressing thing I've seen on any of my tours over the last 3 months, as I've seen nearly all of our portfolio, has been offices where they're trying to make some of these changes and trying to respond to what they think the employees really want, but they haven't changed those seas of workstations and instead have rolled in those tiny phone booths that people are spending all day, taking Zoom calls on. That's just, of course people don't want to come back to the office if that's the environment you have them in. And it doesn't matter to me, I've got foosball or I've got video games, I physically can't do the work you're asking me to do. And so I think that's where the really interesting evolution's happening in our space, is trying to figure out how to keep the spaces feeling engaging and collaborative and keep people want to see each other, people want to be near each other, but also making the spaces a lot more productive than they are today for people. And I think the companies that are really working hard to figure that out are advancing pretty quickly in understanding what the next evolution of the office feels like. But that's, I think, at the crux of the challenge.
Yeah. Well, let me change gears a little bit. So Debra, you've been in the REIT sector for a long time. When you look at where valuations are and everything else, and we can go through a lot of negative things, what do you think investors are missing? What would be something that you think that when you talk to them sometimes you feel like they don't get it, or they're not patient enough, or is it just, they're living in a day-to-day world, so their money's flying because, they got one day to make returns? What do you think about that?
Well, look, over 25 years, and I know Ron can speak to this as well, it's never been a straight line.
Right.
annualized total return for 24 years is 18%, but it has been quite the roller coaster, as you know. In real estate, in business, I think the 100-year flood happens at least every 10 years. And so we're in the middle of a bumpy period.
Yeah.
We do think that there are opportunities, as discussed. I think there is a big value creation opportunity, but I can't say when, right? When will the catalyst be? My job, our jobs, is to produce earnings, to manage risk, to get good capital allocation decisions and in good risk-adjusted return assets. And the valuation is other people's decision. And so we try to focus very much on the things that we can drive and deliver and project, and make sure our mix within healthcare is right and we're capturing that growth as best as we can. And the valuation, you just have to work around it. I mean, and think about your best sources of capital, whether it's a convert at a given time or whether it's a mortgage or a bond.
Yeah.
And always are the best sources of capital to achieve the objectives that you have for the uses of those capital, that capital.
It's interesting because I think what you said on the straight line is a good point, because
it's so not a straight line.
It's not, and I think one of the questions that I was thinking about before was what is the catalyst to really get our sector going? And the easy catalyst was, well, rates go down, right? But that one seems to be a little off the table. So Owen, what do you think, again, broadly speaking, the catalyst is? Is the catalyst destruction in other areas, and you all are in just a better capital position?
No, look, I think I want to come back to also what you asked, Deb, but look, catalyst could be something happens and all of a sudden rates go down. That's an obvious one. For us, hey, the 11% projection of S&P 500 earnings comes true. And earnings are off to a good start. Your firm, a lot of the banks, so that could be very helpful. I think that's an important catalyst. Deals. Somebody does the Blackstone take private last week.
Yeah.
Yes.
That gave the market a lot of comfort, and there could be more of either take privates or mergers and so forth. That could also be a catalyst. But one other thing, I'd also like to make a bigger picture point, and this has nothing to do with what's going to happen next month or next quarter, but it's important. We all think about inflation as negative because rates stay higher. None of us really like that, but think about what that's doing to the value of what we do. So I look at it in our own space, that to construct a premier workplace, which are today about 10% vacant in what most of our clients want, it costs a lot more money to do that. And think about what's going on with the dollar. The federal government has very little responsibility on fiscal policy. Monetary policy is trying to tamp it down, and that's not going to go away. It doesn't matter, I don't think, who gets elected president. That's not going to go away. So this is, I think, very inflationary, and it's destructive for the dollar. And you see, Bitcoin, notwithstanding what happened in the whole that's still an asset that people are interested in. Gold. Investors are looking for other types of avenues other than the dollar, and I think real estate could be one of them. And so, again, this doesn't have anything to do with next month or next quarter, but over the longer term, it's not negative for what we do. Yeah, well, I think also, I assume in most of your spaces, a lack of new supply. Yes. Construction's really going to be tough for a long period of time. I know, Ron, in your space, that was an issue for a while. I'm assuming that's tampered down, and I think with population growth, it helps.
So interest rates are higher. That's a headwind for REITs. Stocks are down, that's a headwind for REITs. But if you look at the kind of the really big picture, new supply is coming down across the food groups. Right? Because money costs a lot more.
Except for data centers.
And if you think about, would you rather deploy capital at a 10% return or a 4% return? Right? The pie eating contest is over. Right? When money was cheap, you guys were handing it out. It was super cheap. It was plentiful. Huge headwinds for all of us to go compete in terms of buying assets. Well, that's slowed down dramatically. And you know, a 10% return buying an asset is a hell of a lot better than a 4 cap rate. You know, it's just compound the money. It's just going to be a lot better returns going forward. And supply is coming down, and yes, cost of money will go up, but I think return on invested capital is going to go up.
Not only does it affect supply, but it, you know, focusing on where the sectors are and the businesses that have some kind of pricing power is, I think, really important in an inflationary environment. And so I think that it can be good if there is an ability to have affordability and passing on some of those increases in CPI to your ultimate users. And for us, when you look at seniors, I mean, one of the surprising benefits of this environment is this is a group of savers that was making zero on their money for almost a decade. And now the COLA increases in Social Security, pension increases, and of course just cash savings at over 5% is a huge boon to the income levels of our customer base. And so there are always positives and negatives about every single fact pattern.
Yeah.
And you just have to sort out who's going to be the beneficiaries and how you can benefit from those trends to mitigate some of the other issues that we're talking about.
Yeah, look, certainly some of the benefits we've seen in the last number of years is low unemployment, and there still has been some savings, and the stock market was up, so people had some money.
Yes.
What we haven't seen, which is going to be interesting, and I don't know how it plays through all this, is if you have a 10-year at 465 or a 1 year at 520, there's competition all of a sudden. We've been a yield-oriented sector in some ways. So what happens from an investment decision perspective? I've talked to plenty of people that say, well, why should I buy a whatever at a 5 cap if I go stick it in treasuries at 5 cap, at 5 interest rate? So that's a tricky thing as people think about you know, alternatives. And Owen, you know, in a different time, you ran Morgan Stanley's investment management business, right? And you know, how do people get their head around that? Because that's going to be, you know, in some ways you could argue that the reason, I always wonder if interest rates went up, there's reasons that it's good to go up, and there's bad reasons it can go up too, right? So to me, a little bit is what's going on that's causing that. Yeah. But how does the basic investor then think through, or any of you, think through the investment decision if I can make this but doing nothing, or, you know, how do you think about that?
Yeah. Well, I mean, I think, again, you make the point, you're comparing it to treasuries, an asset that has a dividend. Well, what that analysis misses is what's the growth. Yep. You know, obviously the treasury has theoretically no or low risk, but it also, you know what you're going to get, and that's it. And anything that you buy as a common stock presumably has some kind of growth profile, and that should be added on top. I think that's why some sectors in the REIT market are suffering more from a stock price standpoint, because there's more question marks out there about what that growth premium is. Yeah. So that's what you have to demonstrate. If you want to trade at a lower yield than treasuries, you've got to demonstrate that that yield can go up. Yeah, we do a correlation we show in all of our pitch books. Yeah. Growth leads to return. You know, it leads to multiple. You know, whatever it might be. Yeah. And I think that is ultimately the arbiter of what happens, not just for real estate stocks, but for any stock, right? And that's just an investment allocation decision. Yeah. I know we've got a handful of minutes left. I'm going to turn the questions back out to you all. If anyone's got something they want to bring up, and we'll see where that takes us as well. Questions? In the back there?
For Ms. Cafaro, given the years since the passing of the ACA, do you have conclusions about its impact on the healthcare office space?
The healthcare, I didn't hear the last couple of words.
Are there conclusions that Ventas has made about the ACA's passing on the impact of the MOB space, healthcare, real estate, and was it good, was it bad? And
yes. The question is about the Affordable Care Act, Obamacare, which at its root expanded healthcare coverage for tens of millions of Americans. And overall, in general, it has been a marginal positive for the outpatient medical business, as well as the, you know, healthcare providers, the hospitals, for example, but a marginal positive. Again, the over 65s, which are the baby boomers, you know, that positive impact plus low unemployment, where people have more employment-provided healthcare insurance, those are even bigger positives for the utilization of outpatient medical and even hospital procedures. So the demographics and the low unemployment rate are both big positives. The Affordable Care Act, which provided Medicaid, essentially insurance across many of the states for people who didn't otherwise have health insurance, that's also a marginal positive.
If I may, just one follow-up, I'm sorry. Have you found more leasing? Has there been greater demand for healthcare, or have the doctors consolidated into smaller spaces?
So in outpatient medical, again, we have 400 million or so of NOI from outpatient medical, mostly on hospital campuses. What we're seeing is a shift of procedures. I'm sure you're seeing it in your everyday lives, from the hospital into those outpatient medical. Many times you can't even tell the difference between the two buildings. And there continues to be good demand. The asset class is a steady core-like compounding growth type asset. So we see that as a very nice, stable, steady compounding growth asset. There is demand from a lot of our hospital partners who are investment grade, AA rated, so we like that. And we've seen good, solid demand, is what I would say. And we expect that to continue because of the ultimate utilization of the patient population.
Thank you. Other questions? Maybe I should ask you all some questions. Good. Well, why don't I cut this off then and just say thank you to our panelists. Thank you to NYU Schack.
Thank you.
And Raquel.